So I see a comment here that says, I want a house, but loan people hate my credit. And that's what the comment says. It doesn't ask a question, but generally, if you have distressed credit, I'll say, there's always a trade-off. A lot of the times, what I will see is when people tend to have distressed credit, they also will have, not a significant amount of money for down payment. Usually, the income is not necessarily as high. That's not always the case, but it's just a trend that I tend to see. So the thing is that there are options out there for somebody with even down to a 500 credit score that are available. We've done deals for people who have a 520, 550 credit score. The trade-off is that when you have higher credit, like let's say you have a credit score that's 650, you will be able to borrow. You can have basically a standard debt to income ratio. You can put minimum down payment. The loan terms and the requirements in other areas besides credit are a lot more favorable when you have decent or good credit. So if you want to come in with 3% down, you want to be able to borrow 47% of your gross monthly income. You need to have good credit to be able to do that. If you have lower credit, there are going to be additional requirements. Generally, if you have a lower than a 580 credit score, you're going to be required to put 10% down minimum. Generally, you are only going to be able to borrow somewhere around 31% of your gross monthly income will be going towards housing. So you tend to buy the same house, you're going to need to make a lot more money every year than if you had good credit. You're going to have to put a lot more money down. There's going to be requirements for financial reserves, basically, where you let's say your mortgage payment's $2,500 a month. If you have lower credit, after you make all your down payment of 10%, pay all your closing costs, you're going to be required to have at least 3 months worth of reserves, $7,500 left over in your bank account. And what I typically see is most of the time when somebody has lower credit, and this is again not in all cases, it generally is something that can be fixed. It just takes money to fix it. You know what I mean? It's usually a matter of you had a couple of credit cards, you let them go. You didn't pay your credit cards and just sort of let them go into collections, or maybe you owe a very high, like if you have a $5,000 credit limit, you might owe $4,999. That tends to drive your credit down. Just that alone typically is not going to get you into the 500s. Usually you would have had to miss some payments or let some debt go or have a significant amount of collections. But generally, if someone has 10% to put down to the housing price, right? They can make a 10% down payment plus pay their closing costs plus have 3 months of reserves. You've got a decent amount of money in the bank. Most of the time, if you have that amount of money, it makes more sense to start throwing money at your credit and fixing it and bringing your score up higher. Because in addition to having all these additional requirements, you're not going to get a favorable interest rate with a sub 580 credit score compared to what you could get above 700. But your rate is going to be 0.5% to 1% higher than if you had a 620 credit score. I'm talking right now, probably, if you're in the sixes with a 620, 640 score, if you have a 550, you're probably going to be in the mid sevens. So it's a significantly more expensive loan. You have to put a lot more money down. Usually it makes more sense in that scenario. Now, there are always exceptions to this rule, but generally I will send somebody who comes with a 550 credit score before they try to buy a house. They get sent to credit repair. You try and do what you can with that, with that money. If you have $70,000 in the bank, maybe you can settle some debts, maybe you can dispute a few things and get that score up, maybe take some late payments off. There's, some of these credit repair guys can really work some miracles. So generally I recommend somebody tries to do that for 3 to 6 months before they, go all in and try and buy a house with credit score that low. But there are options, available. And it's like anything, you know what I mean? It's the same conversation when people say, hey, I can't document my income on tax returns, I want to use bank statements. it's the same conversation when somebody comes to me with that as when somebody comes with low credit. Is like, okay, but the other aspects of the file need to be good. So if you have income that's not verifiable in the traditional way, well, then you need to have good credit and a lot of money down. If you have not a lot of money down, then you need to have good credit and good income. If you have not good credit, then you need to have a lot of money down and good income. So it's like if there's three things, and you have kind of an issue with one of them, then the other two need to be really good. That's the simplest way I can put it when it comes to qualifying for a mortgage.